Okay, so what is the investment scenario? The investment scenario is that a lot of people who earn on a daily basis through their jobs or through their business do save some amount so that they can invest somewhere. Now, why do people invest? That's a basic question. People invest, they ensure that they spend less today so that they can spend this amount sometime in the future. For the requirements, like they have specific goals, like everyone has goals. For example, I have a goal of acquiring a home after 5 years, taking a BMW car after 10 years, and having an international holiday for every year probably. So this is my goal. Now for achieving this goals, I need to have some sort of savings at that particular point of time. Now for me to have that savings, I cannot immediately get a windfall gain on that particular day. So what I need to do is that I need to systematically start saving some amount on a daily basis, on a monthly basis, on an annual basis, so that that amount is being channelized into some investments. So this is where people across the globe do save for the entire purpose and the single purpose, that is that they can invest somewhere. Why invest? So that they can spend sometime later in the future. Now this is a scenario wherein people invest. Now where do people invest? People invest in multiple avenues, starting from, what are the traditional avenues? Gold, real estate. These are the most preferred investment, especially in India. If I were to say gold, real estate, you have equities, you have debt, you have jewelry, you have commodities, multiple avenues of investment. Yes, then there are people who would invest into insurance, who would invest into pension funds, who would invest into arts, who would invest into domains. People, they invest wherever they find up an opportunity. Now what investments are we going to talk about are the financial investments. So when it comes to the financial investment, what people normally do is that they, on someone's advice, on a broker or on a trader's advice or on a friend's advice, they put their money randomly into some equities or any sort of structured product or any financial product. What happens there? Oh, okay, they do not have that much knowledge, so they end up making mistakes, financial mistakes, which results in loss, and they then become risk averse and then come back to the traditional investments, which would not fetch that much return as what they feel like. So what is required here is a proper understanding of investment in the financial markets. So when it comes to investments in the financial markets, there are two ways. First, either you learn, you get educated, which is a long process, and then you invest, and then too there is no guarantee whether you will make money or not. Second, hire someone, hire his or her services, professional services, and invest through them. Now when I go with the second route, there is a problem. I cannot afford their services. These people are gentlemen, these people are white collared businessmen, white collared professionals, having qualifications like chartered accountancy, CFAs, MBAs from high school, and now these people are going to charge me huge. So that is where I may not be able to afford them. So what do I need to do? Here I do want to invest, and I don't want to invest in a plain vanilla type of investments in a simple bank FD account or a savings account, because that is not going to fetch me enough returns, and that return is going to be beaten by the inflation. So where do I need to invest? I definitely need to invest in a right direction, which I know is equities. Equities, of course, there is a risk element, but there is an opportunity. So I do invest in equities, but then I take someone's help. Now this help, when taken to a high professional, a high qualified person, a very well experienced person or an institution at a meager cost, is only possible through mutual funds. So what mutual funds do? They are financial institutions who do a pass-through structure. What is the pass-through structure? In a pass-through structure, mutual fund companies, or I would say the asset management companies, gather the savings from investors. So what do? They gather the savings, or they pool the savings from investor. This pooled amount is then invested into securities. Now this securities can range from, this amount is invested into securities, this securities can range from debt, equities, commodities, and various other aspects. So investors amount is pooled. This pooled amount by the asset management companies is further invested into securities, and these securities then go ahead and generate some sort of returns. So this securities, whether it is debt, whether it is equity, they generate some or the other form of return. These returns are then passed back to the investor, to the one whom it belongs to. So investors' amount taken by the AMC, invested in securities, this securities generating return, and that is passed back to the investors again. What do the asset management companies do here? Okay, they charge me some amount as a fee. That is a meager amount. It's in terms of percentage. As of now, it is around 2.5 to 2.75% as per the latest rules. So this is a small amount that they would be keeping for themselves, and on that behalf, they would be investing the amount in the mutual fund multiple securities. Now this becomes affordable to them when there are multiple investors like me with a small amount of, for example, $1,000 or 1,000 rupees. This is a very small amount that I want to invest, and that is where these guys will help me investments. So what is it going to be? It is more going to be like crowdfunding. What is crowdfunding? Wherein instead of getting 1 crore rupee or $100 million from one investor, you get 10 rupees from, or you get $1 from 100 million different investors, which is rather easy and affordable to them. Similar way in the case of mutual fund, rather than the asset management company managing an individual's 100 crore rupees, they also get small amount, 1,000 rupees from many investors, or 500 rupees from many lakh investors, which would sum up to a huge amount. That is where it becomes affordable to them. So this is the concept of mutual fund, wherein what mutual fund exactly is, that is what I will read. Mutual fund is formed as a trust. Now this is where we understand mutual fund is a financial institution managing people's money, formed as a trust that pools savings of number of investors sharing a common objective. So here the common objective may be what? Maybe investments into equities, maybe investment into debt, maybe an investment into a combination of both. So what? I'll repeat. Mutual fund formed as a trust, a financial institution formed as a trust that pools savings of number of investors sharing a common objective of goal. This pooled savings is then further invested into securities like debt, equity, commodities. This pooled investment is then invested by the asset management companies into various securities wherein they earn returns. So mutual funds offer to invest in a diversified portfolio which professionally manages these basket of securities. Why diversified? Because they are not going to randomly pick up stock from one particular sector. They are going to pick up a variety of stocks, which I myself would find it not affordable. For example, if I have only 1,000 rupees and if I want to buy a stock of TCS or Infosys which is trading around 2,000 or 3,000 rupees, it may not be affordable for me to buy one stock. But if I give 1,000 rupee to a mutual fund who would collect that 1,000 rupee from everyone, and with that corpus, with that AUM, that is asset under management, with that fund, it can get 1 crore rupees through which it can invest into multiple securities. So I may not exactly be investing in one TCS, but I may be investing in a part of it through the mutual fund company. This is where it helps me a lot. Okay. So basically they offer an opportunity to invest in a diversified portfolio which is professionally managed, and these basket of securities are managed at an effectively lower cost. Individually, I may not be able to pay the fund manager salary of 25-30 lakhs per annum or maybe more than that. But okay, when it comes as a pooled investment, my share is very minuscule, that is 2.5 or 3%. So that is where it becomes very affordable to me. As of date, there are around 44 asset management companies in India, and these companies keep coming and going. There are a lot of companies which get shut down, there are a lot of companies which come. So there are 44 asset management companies managing around 14 lakh crore rupees as of the 2015 end data. So this particular asset management companies like HDFC Mutual Fund, which alone together has around 1,70,000 crore asset under management. You have ICICI Mutual Fund, you have Reliance Mutual Fund, Birla Sun Life Mutual Fund, Axis Mutual Fund. These are multiple mutual funds from the Indian domain. You have foreign mutual funds like you have BlackRock, DSP BlackRock Mutual Funds. You have Fidelity. Now Fidelity is, of course, it has shut down its operation and sold to L&T. You have Franklin Templeton Mutual Fund. You have so many mutual funds, 44 asset management companies in India managing this very beautiful business of the mutual funds and the asset management.